Let's connect with Manoj Pradhan, emerging market economist with Morgan Stanley. Manoj, good morning. Thank you for joining us. Manoj, let me start with something which is obvious. Europe. But within Europe, the view is that the center of gravity is now shifted from Greece to Spain, and Spain honestly is a much bigger economy and potentially could be a much bigger problem than Greece.
No, clearly there's been a migration of risks, not just within Greece, but all over the periphery. The immediate concern, though, still stems from what we call a euro divorce, whether Greece has an incentive and will actually leave the eurozone, which would initiate contagion into Spain and the other peripheral economies. Our base case is still that this does not happen, that you do get a staggering on scenario in which not just the peripheral economies, but also the core economies make concessions and move towards a fiscal compact that allows Europe as a whole to rebalance. We've, however, given a 35% probability to a Greece exit, and a euro divorce scenario of that nature would certainly create significant turmoil, not just in European markets, but in global markets as well.
Manoj, so will you expect assigning a 33% probability of Greece's exit from Europe? And do you think financial markets are not really pricing in a disorderly exit of Greece?
Well, it's 35%, close enough. I think there is some probability that is assigned mostly in line with what we have as a probability distribution, but that certainly means it won't show up as a base case. If that was a base case already, I think we would be seeing much more disorderly moves in funding markets, in the currency, and in investor sentiment in general. That has stabilized recently, and I would believe that most people are looking for an outcome out of the Greek elections which does not immediately lead to a Greek exit.
Manoj, do you think 17th of June could be a turning point for global markets?
I'll leave the markets call to our strategists, but I don't think a Greece election, whether it moves into a more benign scenario, actually leads to a solution as far as Europe is concerned. The reason for that is even if we get to a working government for Greece, that does not solve what problems they've got on the solvency front. It still does not make them a viable candidate for getting more funding from markets. All of those problems are still ahead of them.
Manoj, the U.S. economic data of late has been mixed, and the non-competitive data, which we got last Friday was pretty horrible, pathetic, and below estimates as well. Do you think now it's a matter of time we will get a QE3 next week and the Fed will blink again, or do you think after Ben Bernanke's comments last night, that is something which is completely ruled out?
Well, I mean, look, the Fed has blinked a long time ago. When you look at the January FOMC statement, there was no doubt that the Fed was opening the door for further QE in the face of what was obviously a significant downside risk to growth. What changed was the data itself. So the first quarter data came out very, very, very strong, and that minimized the need and the expectation of quantitative easing. I think we always expected to see some kind of a downdraft in growth, because this is typically what happens in economies that are recovering from a credit crisis and a housing crisis. They tend to be in a channel as far as growth is concerned. And it's no surprise now that growth has actually, and the data has actually surprised on the downside. You're looking for an enhanced probability of QE. Our own house view is that there is an 80% probability of quantitative easing at the next Fed meeting in June.
So Manoj, between Asia, or I would say China, Europe and US, which economy do you think will surprise us and disappoint us in the near term?
It's a very, very difficult question. Clearly, the problems in Europe have the greatest ability to surprise to the upside and to the downside, because it's not really necessarily the fundamentals that are driving events all the time. There are a lot of policy decisions have to be made, and those tend to be a lot more surprising. If you're talking about the underlying strength of the economy, though, it's a very different scenario, because Europe clearly is extremely weak as far as fundamentals are concerned. The US has not yet gotten back to its fundamental strength. And on the Chinese side, it really depends on what the policymakers do, how strongly they react, and what kind of reaction they give. Remember, the Chinese economy, we're still talking about a very robust and incredibly high rate of growth. This is not an economy that is teetering on any edge of a crisis. So if it's stimulated and stimulated hard, the reaction will be equally hard. I'm afraid it's really difficult to answer your question.
So where does India stand in this, whole global scenario?
Well, India is a lot easier to answer. I think what India has received is a wake-up call which they really need to respond to. The reason for that being the need of the Indian economy is very clear at this point. What India has needed since the crisis has been better investment in infrastructure, which is a story everyone gets, including the Ps on those stocks. Unfortunately, none of that has been forthcoming. The government policies that have been put in place to fight the onset of the Great Recession ended up leading to higher consumption, which is not what India needed. Further inflation, which the RBI fought very effectively in 2011, is also likely to be stubborn, which means rate cuts from the Reserve Bank may not do as much good as many would expect. And so really what India continues to need is better investment. Barring that, it's very difficult to see what would lead to investor confidence rising again and an upturn in the Indian economy. So more than likely, you're likely to see a slightly longer downturn in which you grudgingly come to realize the fact that investment needs to be turned up.
Manoj, I guess it's easy to come out with the prescription, but what about implementation? What to your mind will change the India mood?
I think the combination of policies that is required, and my colleague Chetan Iyer has done this very eloquently, is to say clearly what you need is better fiscal position. You need monetary policy not to be overly loose so that you don't end up stoking investment. Now, ironically, those look like conditions that would lead to a tighter monetary policy and a fiscal policy stance, but at the same time, if the government is able to fast-track investment projects, particularly large infrastructure projects, then it would actually have a much better beneficial impact on the economy. It would lead to even short-term improvements in potential and actual growth.
Manoj, are you a dollar bull or are you a dollar bear right now?
Over a period of time, as far as EM economies are concerned, the dollar is likely to and will be salutary if it continues to depreciate. This is a trend we've seen for 10 years now, not in nominal terms necessarily, but in real terms. So if you look since 2003, the dollar in real terms against EM currencies has depreciated steadily. What's really interesting is that over 10 years, the nominal EM exchange rate has been flat, but it hasn't mattered because inflation has done the job. And that is likely to continue to be the case. Why is this happening? Well, think about what emerging markets are doing. Emerging markets are showing signs of rapidly rising productivity growth. Their ability to produce things out of a given set of resources has increased. And economics always works to take the imbalances away. So think about when there is more demand, you get higher prices. When there's more supply, you get lower prices. This is exactly what's happening. The exchange rate appreciation of emerging markets is taking away some of the productivity advantage that they've got.
So Manoj, over the course of next 1 year, which economic term do you think we are likely to use more? Recession, depression or stagflation?
I think the stagflationary scenario seems to be a lot better out of the terms that you had used, but really it comes to the response of policymakers, whether that's done the right way and whether it's aggressive enough or not too aggressive. I would think that if we come back in a year, what we are likely to see, if our base case holds out, is the US a lot closer to sustainable growth, either through QE or through its own intrinsic growth. Europe staggering on, but by no means out of the woods, and large problems still ahead of them, including the involvement of the ECB, and emerging markets slowly coming to realize that the potential growth that they had pre-crisis is not the growth environment that they face right now, and significant changes have to be made. So let me clarify that. If you look at the growth strategy of emerging markets post-crisis, it hasn't changed from what they had as a strategy pre-crisis. But clearly the world around us has changed, and emerging markets need to change too.
And what do you think really needs to be done, needs to be implemented in order to get growth back?
The set of prescriptions is much easier for me to give than for them to implement. So we've looked at China in the past. I think it's clear to everyone that a more consumption-driven Chinese economy with a slightly lower growth rate is a more salutary solution. India's problems, I've already talked to you from the investment front. Commodity economies are looking far too much at the commodity sector at the expense of competitiveness in other sectors. Export orientation has not declined at all, and all of these things are pre-crisis strategies which will not have the same returns now.